All right. I wanted to get video number 5 up. We're going to be going over liquidity today. So understanding liquidity in trading and the key to smart market moves. So how liquidity affects price action and trade execution. So go to the first slide. What is liquidity? Liquidity refers to how easily an asset can be bought or sold at its current market price without causing a significant price change. A high liquid market has a high number of buyers and sellers, making trading executions faster and more efficient. Key characteristics of liquidity is high liquidity, more participants, higher trade volume, and stable price movements. Low liquidity, there's fewer participants, lower trade volume, and large price fluctuations. So liquidity is essential because it determines how smoothly you can enter and exit trades without experiencing excessive slippage or price gaps. So what you guys will be learning in this and future videos also, I'm just going to do the explain just what liquidity is and how you guys can use it. Everything I go through with these videos, I'm not going to do a full strategy put together. I just want to give you guys the steps of what you need to learn to create your own strategy, what you can use to become profitable in the future, and you guys can practice on back testing how to use all these and put all the puzzle pieces together. But with liquidity, you guys want to mark out, like with me personally, in the beginning of the day, I mark out my high time frame liquidity draws on liquidity. So I'll mark out 4-hour and 1-hour highs. And usually when you guys get to these areas, you'll want to look for a liquidity sweep and then a break of structure to the upside, and then target your other side of high time frame liquidity. So let's say you take out sell side liquidity and you get a break of structure to the upside and you're showing bullish or buying pressure to the upside. You guys would want to scale down to your lower time frames, look for key entry points, and then you target your buy side liquidity up above your high time frame buy side liquidity. So why does liquidity matter in trading? So smooth price action. High liquidity leads to stable price movements with minimal price gaps. Low liquidity markets tend to have erratic price swings, making trading riskier. So if people, there's different ways, like people scalp trade and stuff like that. There's different ways where you don't have to trade off liquidity. But me personally, I found out through back testing everything and testing different ways of trading and different strategies, liquidity sweeps always work best for me, because you're trying to get in when the banks get in the bigger industries, and you guys want to ride that wave up because these banks will sweep out liquidity, take all these people's stop losses out where they had stop losses set, and then they'll fill in those orders and then continue pricing to the other direction and take out those other draws on liquidity. So you're trying to get in when these banks enter at these key areas, because when the banks enter, they got to enter in big amounts. They can't just click a button just like us and enter a small amount of money. These guys enter with a lot of money, and usually when they enter, they'll drive the market in a specific direction, like if they sweep liquidity, and then they'll drive it up to the other draws on liquidity usually. So this doesn't work 100% of the time. Again, this is trading, guys. It doesn't work all the time. Sometimes banks won't even enter. The price will fake you out and it'll go the opposite direction. That's why you got to use your other confluences on the lower time frames to identify if price is actually going to sweep liquidity and end up going to the top. But number 2, we have tighter bid-ask spreads, not big-ass, bid-ask spreads. A tight spread means the difference between the buy bid and price and the sell, which is the ask price, in small, reducing transaction costs. There's also a wide spread increases costs and can lead to higher execution risk. Number 3, we have faster trade execution. So in highly liquid markets like major Forex pairs or S&P 500 futures and NASDAQ, traders execute instantly and expect prices, at expected prices, in low liquidity markets, so like penny stocks, exotic Forex pairs, you may experience delays or price slippage. So that's why I like using liquidity sweeps. What I trade is the S&P 500 and NASDAQ because they work really well with those two. So another thing we have is market manipulation and stop hunts. So low liquidity areas are targets for institutional traders who can push price to grab liquidity before reversing the market. Understanding liquidity can help traders avoid stop hunts and false breakouts. Like I was explaining before, guys, you want to look for these key areas or your high time frame liquidity to get swept first, and then you'll scale down to like the 5-minute, look for a break of structure, look for an inverse fair value gap, then scale down to your 1-minute time frame and look for your continuation confluences after that. If everything's matching up and we're showing buying pressure to the upside, you'll set your risk to reward on your trade. You'll take your trade. If it plays out in your favor, then that's good. You guys called that a good trade. But if it doesn't, that means we were just wrong, and and then you move on to the next trade. That's why we have a risk to reward. But impact on risk management. So low liquidity increases the risk of slippage, where your order gets executed at a worse price than expected. High liquidity allows for better trade sizing and risk control. So let's go over, like I was saying before, about how the banks want to sweep out liquidity, and the hedge funds and the people with all this money who trade in the market that we're trying to follow the wave with. So who creates liquidity? So market makers and institutions like banks, hedge funds, and liquidity providers. So large financial institutions provide liquidity by placing large buy and sell orders in the market. They facilitate smooth order flow and minimize extreme price fluctuations. They often create liquidity pools to absorb orders and manipulate price levels. Number 2, we have retail traders and individual investors. Retail traders add to the liquidity by placing trades, but do not control the market direction like these institutions do. Like I was trying to explain before, us retail traders, we don't have enough money to move the market like these banks and these bigger like hedge funds and liquidity providers. We want to get in with what they're doing, and we want to ride the wave up and follow their move, and then take profits out of the big move that happens for the day. So retail stop orders are often targeted by market makers to fuel liquidity grabs before price reverses. That's what I was explaining before. You guys will see the liquidity sweep, and then price will move up. You don't want to just enter because price gets at that low, and then you think it's going to continue to go up. You guys want to go down to your smaller time frames, get your continuation confluences, get a good entry, and then you place your trades. So algorithmic and high-frequency traders, these traders execute thousands of trades per second, adding liquidity to the markets. They help reduce bid-ask spreads, but can also cause flash crashes during extreme volatility. And then you also have central banks and governments. In Forex markets, central banks influence liquidity by buying or selling currency to stabilize the economies. For example, the Federal Reserve's monetary policy impacts the U.S. dollar liquidity worldwide. So if you guys want to take your notes out, write this stuff down, this would be good to get. But again, this is just the experience and the research I've done in the past 6 years that's helped me. Once you guys understand liquidity and how the market moves and how the market targets liquidity and all these bigger banks target liquidity and how price moves off liquidity, it can help build a good strategy when you guys use this with the continuation confluences that I'll show you in the future. So key takeaways from the last slide. So liquidity is the backbone of trading, affecting trade execution speed, price stability, and overall market efficiency. High liquidity results in smoother price action, tighter bid-ask spreads, faster order execution, and less price manipulation by institutions. Low liquidity leads to erratic price movements, increased volatility, slippage, and wider spreads, making it harder to execute trades at desired prices. Market makers, institutional traders, and liquidity providers dominate liquidity creation, ensuring smoother market operations while also manipulating price to trigger stop-loss orders. Retail traders add liquidity but do not control the market direction. That's us, making it crucial to understand how smart money moves liquidity to their advantage. Liquidity zones act as magnets for price movements, meaning price often revisits high liquidity areas such as previous highs and lows, order blocks, or fair value gaps. Another one we have is stop hunts occur in low liquidity areas where retail traders place stop losses, allowing institutions to grab liquidity before moving price in the intended direction. And that's what I was talking about before, when you guys are going to see liquidity sweep and then target the the buy side or sell side liquidity after liquidity's been swept. And then time of day impacts liquidity. The London and New York session have the highest liquidity, while the Asian session is typically lower liquidity, leading to slower price movements. And that's why it's good to align your strategy, guys, with what time frame you want to trade. I trade New York session using this strategy with liquidity sweeps. New York session has worked best for me in my back testing, and because of the volatility in the New York session. But London session is good for it too. Asian session, I really never got into trading because it was a little bit slower for me, and I didn't like trading it. So I stuck with London and New York session, and then New York session ended up being my time frame that I trade every day. So another thing is news events can cause temporary liquidity imbalances, leading to extreme volatility and rapid price spikes, often trapping retail traders. This is why sometimes, guys, you'll want to look at the news. Well, most of the time, you want to look at the news for the day, and then maybe decide on what news it is to wait. So, like, let's say there's news at 10 a.m. Sometimes you want to wait till news to come out before you try and get your bias on the day, because news can just have a huge move up and move down and take out liquidity. Then you It could take out sell side and buy side liquidity. Then there's nowhere for you to take a trade, so it's not even worth risking it that day. But sometimes it can go out, take out sell side liquidity, take out all those retail traders, and then move price in its intended direction. That's why it's best to just wait until price comes out. But understanding liquidity improves trade timing, risk management, and helps avoid unnecessary losses due to manipulation. So what I would have to say is mastering liquidity concepts allows traders to anticipate smart money movements, avoid traps, and execute trades with greater confidence and precision. So I think it's really good to learn liquidity and understand it. In this slide, I'm going to show you a couple examples on my chart of where you could see the high time frame liquidity. I'm not going to go over highs and lows yet. I just want you guys to focus on what liquidity is, what it means, who creates it, how to use it, and then in future videos over time, I'll show you guys how to mark all your draws on liquidity with highs and lows and higher time frames, and then marking other draws on liquidity like the 15 and 5 minute time frame for take profits and stop loss levels. So smart money and liquidity pools. Institutions and market makers don't trade the same way retail traders do. Their goal is to accumulate positions at the best possible price while minimizing market impact. They use liquidity pools to execute large orders efficiently, often manipulating price to create the liquidity they need. That's what I was explaining before. Banks and institutions can't enter trades like we do. They got to enter in a big size and with a lot of money. And then usually when they do that, they'll send the market in a specific direction. We hop on that wave with them, and then we take a little bit of profit out of that big move that they send the market in. But again, this doesn't happen every time off every liquidity sweep. It matters how price action wants to move that day. That's why we have our continuation confluences and our confirmation confluences on the lower time frames to determine our bias on the day and see if we are able to take a trade or not. If not, we let the day go, and then we continue on to the next one. So what I would recommend is stop trading like a retail trader, think like smart money, and anticipate liquidity grabs. Use liquidity pools to enter trades at better prices rather than chasing moves. Combine liquidity concepts with market structure and confirmations to increase trade accuracy. Also avoid placing stops in obvious areas. Instead, use wider or hidden stop placement techniques. But how institutions use liquidity. So big players don't buy or sell randomly. They require large amounts of liquidity to fill their massive orders without moving price too much. They manipulate price to create liquidity, often triggering retail traders stop losses before moving price in the intended direction. So stop hunting strategies are used to generate liquidity, pushing price into key levels where retail traders have placed stops or breakout entries. Another one is market makers and banks create artificial moves, so liquidity grabs, to engineer liquidity pools before making real market moves. And another one is they target retail emotions using fear and greed to force retail traders out of their positions before taking price in the intended direction. So an example of this is if institutions want to go long, they may push price lower first, take out sell side liquidity like I was explaining before, to trigger the stop losses of existing buyers. That creates liquidity for their large buying orders. They fill those orders, and they end up pushing price up to in the up direction towards our buy side liquidity, and that's how they drive the market up. So we want to hop in on the trades with them while they drive the market up, and then we'll end up executing our trades to what take profit levels we have above. So let's go to the next page. So identifying liquidity zones on a chart. So you have support and resistance zones, which I'll make a video on in the future too. This is just, with this Master Trading Futures Blueprint, I just want to go over the basic stuff of what you guys need to learn to help become successful in trading. These are just the step-by-step stuff that you guys could do research on. Use the notes that I give you here, and also do a little bit more research on with other people. But I'm going to be making more videos in the future about all these things and going in depth with them. Right now, I am just getting started with YouTube and social media with this stuff because I've been doing a sport for so long. So I'm just trying to take my time and get as much good information out there as possible to help you guys. But so we have retail traders often place buy orders at support and sell support and sell orders at resistance, making these areas liquidity-rich zones. Smart money will often push price beyond these levels to trigger stops before reversing. So watch for liquidity grabs at key levels before entering trades. For example, if price is approaching a strong resistance area, institutions might push it slightly higher to act like price is going to keep going up, fake a breakout to trigger stop losses before reversing it down to the other side. And that's why we have our continuation confluences to identify this stuff. We just don't enter a trade right away because we think liquidity wasn't swept or liquidity was swept, and then we don't enter off any continuation confluences. That's not a good way to trade. So another thing is wick rejections, liquidity taps. So long wicks indicate price tapping into liquidity pool before reversing. Institutions use wicks to absorb orders before moving in their intended direction. Multiple wick rejections at the same level signal a strong liquidity zone. So let's say we're going down towards our sell side liquidity. We hit a 4-hour low and a huge wick ends up on a candle. So we get a huge wick down and then a bullish candle out of it. That's most likely that liquidity is being grabbed. We stopped out a lot of orders, and the banks are about to fill in their orders and continue price in the up direction. So an example of a long wick through a key level often signals a liquidity sweep before price moves back in the intended direction, like I was just explaining. But you just don't enter off of that wick, guys. You guys got to scale down, like I keep saying. Look at your 5-minute, look at your 15-minute, look at your 1-minute continuation confluences, and then evaluate after that. So equal highs and equal lows are often good spots for liquidity pools. Retail traders place stop losses just beyond equal highs and lows, creating ideal liquidity pools. Market makers engineer liquidity grabs by pushing price beyond these levels to trigger stops. Price usually sweeps these areas before making a real move. So how to trade it: look for a liquidity sweep at equal highs or lows, followed by a market structure shift before entering a trade, and then you guys would target whichever high time frame liquidity you guys have below or above whatever trade you guys enter in with it's the opposite of where you guys took out the equal highs. So if we took out equal highs, we swept the liquidity off those equal highs to the upside, and price starts to shift structure to the downside. We'd scale down to our lower time frames, look for an entry, and then target our sell side liquidity down below. So high time frame liquidity zones. This is where you guys can mark out your high time frame areas to see good draws on liquidity. Again, these areas aren't going to work every single time. That's why we use our continuation confluences for them. But these are good ways to mark them out before you guys start trading during New York session, London session, Asian session, because these could be key levels where the market can react off of. So we have liquidity is stronger on high time frames because more traders place orders at these levels. So what I use is the 1 hour and the 4 hour highs and lows. These act as significant liquidity zones because they attract stop orders from both day traders and swing traders. Institutions often target these levels before making large market moves. A sweep of a 4 hour high or low is a strong liquidity signal. Watch for price rejections and structure shifts. So example, if price takes out a 4 hour high and then rejects strongly, it may indicate a liquidity grab before reversal to the downside. How to identify liquidity on a chart? You mark equal highs and lows, support and resistance zones, and recent swing highs and lows. You can watch for price sweeps beyond these areas before reversing. Use higher time frame liquidity levels like the 1 hour and the 4 hour, like I was saying, as key zones for major moves, and look for stop hunts and liquidity taps before entering a trade. So a breakout and a fake out zone, this stuff can also happen. So retail traders love breakouts, but institutions use them to create liquidity. Price often breaks a key level briefly before reversing. This is called a stop hunt or a liquidity sweep. So real breakouts tend to retest the broken level before continuation. So how to trade it: instead of entering on the breakout, wait for liquidity grab and confirmation, like I was saying, on your lower time frames before taking a position. So liquidity zones exist where retail traders commonly place stop orders. Smart money uses liquidity grabs to enter trades at better prices. Higher time frames of highs and lows of the 1 hour and the 4 hour hold strong liquidity and often act as reversal points. Fake breakouts, long wicks, and liquidity sweeps are signs of institutional moves. So mastering liquidity zones will help you avoid stop hunts and trade with the smart money and not against it. So that's a little bit of information I have on liquidity sweeps. Hopefully you guys get some information out of that. I'd go back and take some notes and rewatch the video if you guys can. I'd also do a little bit more research on YouTube or whatever you guys use on liquidity and how liquidity works, and again, doing more information on it, but I feel like I gave you guys some key points on what liquidity is, how to identify it, and where to spot it in the markets. I can do a quick, brief example right here real quick for you guys. Let me go to my TradingView account. So, I'll X this out for you guys. So if we go on the charts here, we'll go to the 4-hour time frame. So again, we mark out 4-hour draws on liquidity. Like today, we targeted this 4-hour low. So as you can see, a low is a candle down, then a candle up. This is a good spot of liquidity that I targeted today. So this would be a good draw on liquidity right here for either a reversal up or a take profit level. Like for today's example, to look for another one, let's say we want to look for a 4-hour high on liquidity. That's an up candle and then a down candle after. So we mark the highest point of the wick. There's a high. What you guys should do is go back in your charts and just learn how to mark these out. Same thing with the 4-hour and the 1-hour, guys. If you want to mark a low, it's a candle down, then a candle up. You mark the lowest wick out of the two. If you guys want to mark a high, it's a candle up and then a candle down, and you mark the highest wick out of the two. So like here, for example, this is a high. We have a candle up, then a candle down. There's the 4-hour high right there. This isn't a 4-hour high because it's already been swept out, as you can see, and price did move down. So if we were coming into the market on this day right here, and 10 a.m., as you can see, we came up, we sweep this 4-hour high, we scale down to the lower time frame, and then we look for entries and target this 4-hour low down here, as you can see. So we had this 4-hour high before this candle came out. We came up, sweeped it out. As you guys can see, this works. The banks and institutions filled their orders here, and then they pushed price down to the sell side liquidity down here. So that's a live example right there, you guys can see. Let's do a couple more. If we want to find another high, candle up, candle down, mark the high right there. Price never came up to this area. Let's mark a low, got a candle down, candle up. Boom, here's another area. Price came down, tapped into this area, swept through it. We'd scale down to the lower time frame. Price pushes up, takes out all these draws on liquidity up here. We have a 4-hour high right here. We have a 4-hour high right here. And we have a 4-hour high right here. So this could have been our take profit. This could have been our take profit. And then this one could have been our take profit. So when marking these out, guys, all you got to do is learn how to see highs and lows. I'd go on your charts. For a low again, candle down, candle up. Boom, there's your 4-hour low. For a high, candle up, candle down. We have a candle up, candle down. Boom, there's your 4-hour high. And then you do the same on the 1-hour time frame. So we go to the 1-hour time frame. We look for a high. So look, we have a high right here. Candle up, candle down. Mark the highest part of the wick. There's our 1-hour high. Same thing for a low. Candle down. Opposite, I mean, for a low. Candle down, candle up. Mark the bottom of the wick. Boom, there's a low. And then we have another high right here. Candle up, candle down. Boom, there's a high. So what I would recommend to do, guys, is go back in your charts after doing some research on liquidity. Go back and back test and just mark out these key levels. Mark out your highs and lows on the 4-hour and the 1-hour, and just see how price reacts to these levels over time. And you'll see that it works off liquidity sweeps. So hopefully I gave you guys good information on that. I am going to make future videos. I'm just trying to get these videos out as quick as possible too, because I'm doing the vlogs, the workout videos, and trading. So I'm just trying to do everything at once. I promised I'd get these videos out as quick as possible. I have 5 more to make after this, so this is going over liquidity. If you guys are watching this one first, I recommend starting the. I made a playlist of Master Futures Trading Blueprint. I'd go back, watch from the beginning, and just absorb all the information I'm giving you. All the information I'm giving you here, guys, is not gonna make you profitable right off the start. You guys got to learn how to study this stuff, do your research on everything I'm teaching you. I'm giving you the key stuff to help take the steps to become profitable. But you got to learn how to study and put this stuff together on your own. Nobody can make you profitable. It's up to you at the end of the day. I could teach you all the strategies, the confluences, everything like that. But with trading, and why it's so difficult is that most people can't deal with the psychology part and how to put all these puzzle pieces together. It's easy to learn a strategy. It's easy to understand some of this stuff. But what's not easy is learning how the market moves, who drives the market, how to control your emotions when trading, when to use these confluences, when to not. A lot of things tie in together. So hopefully I gave you guys enough information. Like and subscribe on these things, and I'll keep getting these videos out for you. Appreciate it.